Okay, in this question, this is question November 2022. I'm going to show you the application of MFRS 138 intangible asset. In this question, you are going to deal with intangible asset that arise through separate acquisition, and also the categories of intangible asset which are internally generated but that is not recognized. And again, what happened if the intangible asset that was somehow at the bottom here, that it is divided into two, this question. So I will start with question A first, but question B is actually on intangible asset that has indefinite useful life. So let's look at what you have here, and I'm going to go through with you, and let's see whether you can apply what we have learned. So you have Kasturi Berhad that actively manufactures and sell electrical appliances for local markets. So that was the business of the company. And on 1st January 2023, Kasturi acquired a prototype design. So you have an important word here, acquired. And what was acquired? You acquired a prototype design. So a prototype design is not a tangible asset, not a PPE. Design is an example of intangible asset, right? Because it does not have the physical form, right? It was just a design. And the word acquire here, if you can see the word acquire means it is the one that arises through separate acquisition, meaning that it was separately acquired. So when it arises due to separate acquisition, this prototype design is going to meet the criteria for the definition of intangible asset, meet the definition of intangible asset. All right, that was on 1st of January 2020. 1st of January 2020 is the date of the purchase of that prototype design. And you are informed further regarding that, where it was amortized over straight line basis, and that was over the legal life of 10 years. So legal life, which is the life allowed by whatever jurisdiction, and this useful life is the legal life of 10 years. So when you have the information on finite useful life, like the case here, 10 years, so you are going to amortize. So let us see first what are the initial costs, because you are informed the cost incurred here. So we are going to look at which are the costs that will be capitalized and which of the costs that will have to be expensed off. The rule under here is similar to MFRS 116, where the initial cost would still be the purchase price plus directly attributable costs. This is for the intangible asset that arise through separate acquisition. And whenever you have maybe item like the cash equivalent, you may have to consider the present value of that particular cost that you incurred. But here it was just this. Purchase price 8 million. So you need to go and see what are the requirements. Requirement number one is for you to state the capitalization criteria for the asset arising on development costs. So we are not going to do this yet. We are going to KIV this because this one is related to intangible asset arising through R&D. We are going to do this, which is number 2 and number 3. We are going to explain the accounting treatment for the above transaction, which is from 31st of December 2020. So meaning that you are going to explain whatever happened from 1st of January 2020 until 31st of December 2020. 1st of January 2020, you are going to explain what is the initial recognition. You are also going to explain what is the initial measurement. 31st December 2020, which is at the end of the year, right? You are going to explain the subsequent measurement. And you are going to look whether the asset uses the cost model or re-evaluation model. So there are two options for intangible asset under subsequent measurement, either cost model or re-evaluation model. I put the RM. Under cost model, you are going to find out what is the cost minus accumulated amortization minus accumulated impairment loss. And that what you get here is the carrying amount. Under revaluation model, you are going to find out what is the revalued amount, and you are going to find out what is the subsequent accumulated amortization and subsequent accumulated impairment loss. Then you will get your carrying amount, CA. Okay, that was just a brief overview of the subsequent measurement, which is the measurement after initial recognition. Right, you need to explain this: initial recognition, initial measurement, subsequent measurement. And you need to mention what happened under subsequent measurement in the SOPL and what happened in the statement of financial position. So you need to explain the asset that will be shown in the SOFP and what are the expenses in the SOPL. Okay, let us read further. So now is for us to calculate initial cost, because when you want to explain for your accounting treatment, you need to go and explain on what is initial cost. That will be under initial measurement. So initial cost, you will have to talk about here, which is under initial measurement. So we go and check how much is the initial cost, even though the question does not ask you to calculate, but you must calculate to get the figure. So number one, purchase price. Purchase price, normally you will capitalize because this is similar to MFRS 116. Import duties, capitalize or expense off, class?
Capitalize.
Capitalize.
Okay. For the discount here, 5% trade discount, that is part of initial cost, but you will have to deduct again the initial cost. So meaning that you need to include this by deducting the 5% from the purchase price, right? So the 5% has been calculated for you, where 5% from 8 million was 400,000. And then you have the nature of the expenses there, admin expenses. So admin expenses is expenses which are not directly attributable expenses. So these are the day-to-day expenses. So this will be expense off. It does not meet the recognition criteria. Professional fees, similar to MFRS 116, this will be capitalized. Initial operating costs. So this one is also something to do with operating expenses. So this will be expense off. So you can calculate what is your initial cost now, right? So let us look at the information that is given at the bottom. So that was the first part that I show you here was the information on initial cost and on initial measurement and also on initial recognition, the one in yellow. Now let's look at the one that you have on 31st of December 2020. 31st of December 2020 is after the date of initial recognition, so you are informed on what happened on subsequent measurement. So you are informed that you incurred 70,000 in developing its own customer list. So the word incurred here, this is not relating to the same asset. Now you can see that it was not relating to the same asset. This is about you incurred. Wait, yeah, just erase this for a while. Okay. You incurred 70,000 in developing what? Customer list. So customer list, if you acquired from the another party or third party, that will be recognized as intangible asset. But here you are informed you incurred it, meaning that you internally develop it. You develop it internally. So for the customer list that you develop it internally, so therefore this is not an intangible asset. And this does not meet the recognition criteria of intangible asset. It will be expense off. Why? Because the cost of developing the customer list internally cannot be distinguished from the cost of running the business as a whole. Maybe you can go back to this particular lecture that I have already explained much earlier. Let me just go back. Internally generated intangible asset. But yeah, I'm just trying to get back to the particular slide. If you can tell me what number is the slide, that will help me to find it. Okay, this one. Internally generated intangible asset. In our case, it was a customer lease that was being developed. So therefore, it does not meet the recognition criteria, which happens to be here, the customer list. So therefore, you cannot recognize that as intangible asset because there is not an identifiable resources. So that was for this particular situation. So for this customer list, this is not intangible asset, so it must be expense off. So all this information regarding estimated useful life, you shall just ignore it because this is not an intangible asset. At the same time, you also have another thing being done by the company somewhere October 2020. October 2020, Kasturi sent some staff for training. Send the staff for training. And when they send the staff for training, the cost incurred by the training is 150. So sending staff for training is just an operating expenses. And that means this is not an intangible asset. This will be expense off. Even though they claim that the training should, the benefit from the training should last for 4 years. So still again, the training that was uh, incurred, the training here, this is being expense off because this is the operating expenses. So training is the case where you do not recognize the cost, you will expense off. So these are also explained in MFRS 136. So where we have done it much earlier. If you can check, you will see that that was mentioned somewhere here in the slide regarding training. I just show you. I cannot find it. Never mind. You can just check later. Um, we go back to the question. All right. So that was the case for the training. So training is another issue, but that training here that you have is not for you to go and recognize. And the next one, you are informed on 1st July 2021. You are informed regarding what? The fair value of the prototype design. So I take the word prototype, so I use yellow just now. So fair value of the prototype design was 8 million. So there is an information on fair value, and you are also informed the company use a revaluation model. So for this one, meaning that the company is using this one, revaluation model. So you are going to find out what is the carrying amount by taking the revalued amount, which is 8 million. And you are going to find out what is the accumulated amortization and what is the accumulated impairment loss. So let us just do some calculation first before we start. Right? So I will show you how to calculate the carrying amount. But before that, remember you are going to explain what? You are going to explain this. Initial recognition, initial measurement, subsequent measurement. And our subsequent measurement here is revaluation model. So before we have done that, so we have to go and calculate what is the initial cost. So if you calculate the initial cost, how much is the initial cost? You'll be able to find that. So you can total up 8 million plus 1.5 minus 400 and plus 80,000. That was your initial cost. And if you do that, So I will be doing it here at the bottom here. I'll be doing here. So I'm going to show you the cost. Cost means initial cost 1st of January 2020. So that would be 8 million plus 1.5 million minus 0.4 million. Okay, what is that? That is the trade discount, and you are going to add the professional fee. Professional fee is 0.08 million because it was 80,000, right? So you will get the figure 9180 if you do that. Check your answer. And then, since the company has informed that there is an estimated life of 10 years, so this customer list will have to be amortized. So what you're going to find out here is I'm going to show you how to calculate the amortization. So I'm going to show you the amortization. So the amortization would be where you will take 9.18 million. If you have any residual value, you will deduct. So I put here minus residual value, but there is none. And you are going to divide by the finite useful life. Our finite useful life here is 10 years. Right. So if you do that, that amortization that I'm doing here is on 31st of December 2020, the first year. So how much is that? You will have 9.18 divided by 10. So you will have 9180. Yeah. Oh, sorry, 918,000. So 918,000. You have 918,000. So this is your amortization. For this amortization, journal entry would be debit. If you are asked to do journal entry, debit amortization in the SOPL with the figure 918, and you are going to credit accumulated amortization with the figure 918. Okay. What you get after that is what you call carrying amount. So this is the carrying amount on 1st of January 21. 1st of January 21, which is 1st of January 21 means carrying amount also on 31st of December 20. And the amount is, just do the deduction, take your calculator. How much is that? How much? Class? Can you do the calculation? Have you done the question? That's the question to start with. Have you done the question?
Yes.
How much? How much is the figure here?
8262.
8262.
Thank you. So 8262 is the carrying amount that you have to include later in the accounting treatment that you mentioned here. So let us go and do the accounting treatment now, and let's just explain that in the proper sentence. So let me just show you, where is it? It's here. Okay. So we will start off by explaining the initial recognition. So the first sentence that you can see here, this part is all on initial recognition. This is on initial recognition. So you have to write that it shall be recognized as intangible asset because it meets the definition of intangible asset and the recognition criteria. You need to mention identifiable because that is the intangible, the recognition criteria. And then the key criteria, control over resources and future economic benefits. So this is what you relate to initial recognition. So initial recognition. So all these are about initial recognition. So I just erase that because I've already written. And then at the bottom, you will now explain initial measurement. So when you explain initial measurement, you need to mention how much is the initial cost. So you show the calculation. So it is initially measured at 9.18 million and show the amount. Right? That was initial measurement. And now you will come to the subsequent measurement. This is subsequent measurement. And you need to explain what is under revaluation model. Under revaluation model, that would be the case of for you to do it in 2021. However, what you can see there, can you check your question? Check your question. You are asked to explain only up until 31st December 2020. So you are not going to explain regarding this fair value information yet on 1st of July 2021. You are not going to do that yet because you will just explain up until 31st of December. Up until 31st of December, what you have to explain is regarding this, the amortization. Yeah. What is the accounting treatment for amortization and how much is the carrying amount after the amortization? So you will explain what you have calculated here. So therefore, you are going to mention that it is being amortized. First mention that it has definite useful life. How much? Definite useful life is 10 years. The prototype is to be amortized over the useful life of 10 years. So if the asset does not have finite useful life, let's say indefinite useful life, there is no amortization. So show the amount that is being amortized, 918, show the calculation, and that was being expensed off to the statement of profit or loss. So you need to mention that amortization is an expense. You need to also mention also that it is expense of where to. So SM here is subsequent measurement, RM here is revaluation model, A is amortization. So this is actually what we are explaining for this part. Yeah, we are explaining how much is the asset being amortized and how much is the carrying amount. So we're going to do that. The next one. So first explain what happened in the SOPL. And now you are going to explain what is to be shown in the statement of financial position. So the CA here writes carrying amount. Carrying amount. So the carrying amount of the prototype as at 31st of December was 8262, the one that you calculated, shown in the SOFP. So that was for the case of prototype. Remember, you also have two more expenses. One is admin cost, and then you also have staff training costs. This one. Right. So explain what to do with the admin cost of 20,000 and initial operating losses. Which one is that? The one in the table given here. This one here. This 20 and this 30. You also need to explain about those expenses, those costs that you expense off. And also explain about the customer list and the training costs. So you have 4 items to explain as well, which is admin cost, initial operating cost, the training costs, as well as the internally generated customer list. So let us look at that. Okay, for the admin cost that was incurred during the acquisition of the prototype of 20,000 and initial operating losses of 30,000, it will be expense off. The reason is because they do not meet the recognition criteria. The next one is on the internally generated customer list. Internally generated customer list here. And the one here, the one that I have highlighted much earlier, customer list. Right. So that one cannot be recognized as intangible asset because it does not, it is actually the cost of internally generated, and it cannot be distinguished from the cost of developing the business as a whole. So this is the paragraph under MFRS 139 that mentioned that you cannot recognize internally generated intangible asset. So internally generated customer list is not an intangible asset, and therefore they are being expensed off in the SOPL, where in the year it was incurred against the profit for the year. The next one is about the staff training cost. The staff training cost, how much? Mention the amount. It cannot be recognized as intangible asset, so you must mention that it was expense off to the SOPL since the company has no control over the staff. So when you send off the staff for training, they come back from the training, they can still leave the company because you cannot control them. So because since you cannot control them, the training cost is an operating expenses, and therefore it has to be expense off. So that one will give you 4 marks. So that was, I just split all the explanation into different paragraphs so that you can see the point. Now let's look at the second requirement. Second requirement is for you to explain the accounting treatment to show the relevant entries to record the above transaction for the year ended 31st December 2021. So 2021, one thing happened here is there was a revaluation of prototype that you earlier recognized as intangible asset. So that prototype now will be revalued. So let us just do some calculation to find out the fair value and compare the fair value with the carrying value on the date of revaluation. Right. So let us look at the next one here. I'm going to do amortization, the second amortization. So the amortization here will be the amortization that is from 1st of January 2021, the second amortization, sorry about that. Until 30th June 2021. Why only for 6 months? Because the revaluation took place on 1st of July 2021. So you just need to amortize the asset before the date of revaluation. So that was just for 6 months. So to calculate the amortization, again, you take 9.18 million, you divide by 10 years, but now you need to multiply by 6 over 12. Why 6 over 12? This one is 6 months, right? Amortization period here. And therefore, you will get the figure. How much is that? 918 divided by 2. So 459. Okay, because half of 918. So 459 is the amortization. So you take carrying amount minus the amortization. What is that? Can you do that now? 8262. Take your calculator and then minus 459. How much is that? Class?
7803.
Okay, thank you very much. 7803. So this 7803 is the carrying amount on the date of revaluation, 1st of July 21. I put here DOR, date of revaluation. You will compare that with the fair value on 1st of July 21. Oopsie daisy. And when you compare that, the carrying value was 7803. The fair value was given here. 8 million. This one, 8 million. So you will compare and you can see that carrying value is less than the fair value. So here you will have a revaluation surplus. Revaluation surplus, this is initial revaluation, the first time that you revalue, where fair value is more than the carrying value. And that surplus is how much? How much is the surplus, class?
197000.
197,000. Okay, you are asked to do the journal entries for the year ended 2021 as required here, the journal entry. So what you must journalize is this. Let me show you. Number one is that you need to go and record only transaction for 2021. 21, which is the first one is this, the amortization. You need to go and do the journal entry for amortization. So you need to go and debit amortization, credit accumulated amortization. However, there are two entries that you need to do here. One is to recognize the amortization. Another one is that you need to eliminate the accumulated amortization. Why? You have done the revaluation. So on revaluation, the accumulated amortization must be eliminated, meaning that 918 plus 459 must be eliminated. But in the current year, you must recognize 459. So I'm going to show you this in a short while. And number 3 is this. You need to record the revaluation surplus. So you need to record the surplus by, this is first revaluation. You need to go and debit this to prototype and credit that to the asset revaluation reserve prototype. So here you have 1, 2, 3 entries. So then let us look at the entries here. So we start off with the so-called surplus. So this is the surplus. So you the first entry here is to record the surplus. So to record the surplus, debit intangible asset, credit asset revaluation reserve, surplus. Here is 197. So you must write down prototype because ARR here is for prototype. That happened on 1st of July 2021. And then on 30th of June 2021, 30th of June, before the date that you get your surplus, you have already provided some amortization for the 6 months period. That was 459. We have done the calculation earlier, right? So debit amortization expense in the SOPL, in the profit or loss under admin expenses, and credit accumulated amortization. How much? 459. So I will put this side by side so that you have a better view. Just let me do that. Okay. Okay, you can see here, the journal entry is right here on your right side. So 197 is this one here. This is what you show here, 197. And 459 is this one here, the amortization that you record. And the elimination of accumulated amortization would be before the revaluation took place. It was not just 459, but it was together with the previous year amortization. So you will see that there was 918 prior year plus the current year amortization 459. So it was all together 1377. So you will eliminate the accumulated amortization and you will credit intangible asset. Here is prototype. So you can credit straight away prototype design, which is your intangible asset. Right. So that was for 4 marks. Can you follow me, class?
Yes, madam.
All right. Thank you. Let's go and do the next part. So this is how you do the journal entries, and I've also shown you how to explain the accounting entries. Let's go and do the next part, which is this one, number B. B, yeah? B is dealing with intangible asset that is being acquired. So let's read the question. Where you have 1st January 2016. So this is the date of where you acquired a patent. Acquired. The key word here is the word acquired. So when you have the word acquired, this means that this is the one arising from separate acquisition. And the asset here is patent. So therefore, this is an intangible asset, and you need to understand that the initial cost was given to you. So this is the initial cost, and therefore this is the initial recognition date, and this is also the initial measurement date. However, you are informed that that cost of 8 million here, it can be used for indefinite period. The word indefinite period means, so it is used for a period that you do not know how long will be the limit. So for asset that has indefinite period, there is no amortization. And for asset that has indefinite period here, you are not going to amortize, but you are going to just test for impairment. So we have the information on impairment is given here. So in this particular question is about an asset that was having indefinite period, no amortization. However, the asset being tested for impairment. So after 3 years, on 1st January 2019, MUAS reviewed the useful life. So the useful life at first was indefinite. They reviewed the useful life, right? So here, I will write here at the bottom. So you will have first indefinite useful life. And now indefinite useful life is being reviewed. And when it was reviewed, they concluded that the economic benefits to be derived will not last indefinitely, but it would just last for 8 years, right? Meaning that useful life was somehow would be 8 years. So meaning that there is a change in accounting estimate here under MFRS 108, indefinite useful life, which is now becoming definite or finite useful life. So under indefinite useful life, no amortization. Under definite useful life, you will have amortization. You're going to provide that. Under indefinite useful life, you may have to do some impairment tests if there are indicator that the asset is being impaired. Same goes for the asset with definite useful life. So what makes them different is that one has amortization, the other has no amortization. You are informed on the impairment test. So let me just highlight impairment test information in a different color. An impairment test was conducted on 31st of December 2021. After how many years, you can check that. And they determined that the present value of the future cash inflow, which is actually the value in use, to be 30% of the initial cost. So you are not informed what is the fair value less cost to sell, but you are informed what is value in use. So when you are informed the value in use to be 30% of the initial cost, you can find out how much is the value in use. Yeah, value in use here. And MUAS also received another offer to purchase the patent for 3 million. So you have another one here, another offer, which is the fair value less cost to sell, that where you receive an offer to purchase. If you have the offer to purchase the patent, meaning that you have the right to sell it. So this one is actually fair value less cost to sell. So here you have to go and check how much is the value in use. The value in use is 30% from initial cost. Initial cost is 8 million. So value in use would be 2.4 million. So you will compare 2.4 million with the 3 million. Remember, MFRS 136 recoverable amount is the higher between fair value less cost to sell and value in use. So you can see that value in use is 2.4 million. Fair value less cost to sell is 3 million. So fair value less cost to sell 3 million. Value in use 2.4 million. So the recoverable amount would be the higher between the two figures. So it would be 3 million. And you are going to check how much is the impairment loss. And that happened on 31st of December. You are asked to discuss the proper accounting treatment. So when you ask to discuss the proper accounting treatment, you also need to do some calculation for that information on impairment there. So you can do the calculation here. I will erase all this. Okay, we erase this. I need space to write, so you can calculate now how much is the impairment loss. You can do that. Can you do that? Go and find out what is the carrying amount of the asset. Compare with the recoverable amount, and later find out what is the impairment loss. All right. So let me just do some erasing here. Okay. You can start calculate. Okay, enough already. So let's do this for our case of intangible asset that has changed the useful life. So we start from the beginning, 1st of January 16. What is the cost of that? What was the item just now? Cost of the patent. Patent. The cost of the patent is 8 million. Right, given? And from 1st of January 2016 until the date 1st of January 2019, from that date until 1st of January 2019, there is no amortization. So if you were to talk about amortization, there is none. Why? Asset has indefinite useful life. So I put here amortization and I will write nil. So meaning that there is no amortization because the asset has indefinite useful life. And therefore the carrying amount, the screen is not giving cooperation to me. The carrying amount is still 8 million. On 1st of January 2019, you are informed that the company has reviewed the useful life, right? And the useful life has been changed. Are you with me?
Yes, madam.
Okay. So this one is carrying amount 1st of January 19. So under this period, you have already reviewed the useful life. You reviewed here, you're informed it was another 8 years. So the carrying amount is 8 million, and for the period 1st of January 2019 until the date 31st of December 21, you are going to calculate the amortization. So I will calculate here accumulated amortization because I want to know how much is the amortization starting from January 2019. So in January 2019, the estimated useful life is 8 years. So you are going to find out that 2019, so 31st December 2019, 31st December 2020, 31st December 2021. This is 3 years, right? So accumulated amortization. So you will calculate 8 million divided by 8 years. 8 million divided by 8 years. 8 million divided by 8 years, and you are going to times 3 years to get the amortization, accumulated amortization for 3 years. How much is that? So each year is 1 million. For times 3 years, it becomes 3 million. Why do I bother about this? Because I want to find out what is the carrying amount on the date of impairment, 31st of December 21. So the carrying amount is 8 minus 3. 8 minus 3 is
5 million.
Thank you. 5 million. You can compare that with the fair value. Not fair value, sorry, with the recoverable amount. Recoverable amount. So your recoverable amount, we have already decided earlier, it will be at the lower between the fair value less cost to sell. So you're going to take the 3 million, right? Let me just erase this. Okay. So recoverable amount. Recoverable amount, you have the fair value. Fair value was 3 million. Value in use, we have calculated just now 30% times 8 million. So 2.4 million. 2.4. So I take this because it is higher between the two figure, right? Do you still remember this? What you learned in MFRS 116 last semester? Class?
Yes.
Very good.
Yes.
So you have 3 million. So you can compare this with this. You take this figure, you include here because it is higher. So you can see that carrying amount is higher than the recoverable amount by 2 million. And that by how many? Let me just see how much is that. By 5 minus 3, 2 million. And this is your impairment loss. Your impairment loss. And that impairment loss will be what you need to recognize, which is the impairment loss for 2021. So we have to explain that, not to do the debit credit, but you have to understand that you need to go and explain what happened here, and how do you treat this. So for impairment loss, you will debit impairment loss, credit accumulated impairment loss 2 million. 2 million. So let us look at the accounting treatment. But you need to do a little bit of calculation. You don't have to do very detailed, but just a simple one will do. Okay, so let's just look at this. So you are asked to explain for the year ended 31st of December 2021. So for the year ended 31st of December 2021, you need to explain what happened on 1st of January 2021 and what happened also at the end of the year 31st of December 2021. The two shocking pink that I include there. So start from 1st of January 2021. So 1st January 2021 is not the initial recognition. So you just need to mention on what happened at the beginning of the year. So explain what is the carrying amount. So you just mention carrying amount of the not license, it was a patent. Patent, yeah. Patent was 5 million. Show how do you get that 5 million, which is you take the cost minus the accumulated. I put here AA. AA is what? Accumulated amortization. Accumulated amortization just now was 5 million. So you get 3 million, sorry. So you get 5 million. Then you need to mention about the recoverable amount as at 31st of December 2021. So which is again the date which you are concerned. The recoverable amount of the patent was 3 million. That was the higher of value in use and the fair value less cost to sell. All these are given marks. So you need to show how do you decide the recoverable amount. You must show, right? Since the recoverable amount of 3 million, remember we take the fair value less cost to sell to be the recoverable amount, since fair value less cost to sell is higher than the present value in use. So since the recoverable amount is lower than the carrying amount was 5 million, you have to recognize an impairment loss. Impairment loss of how much? 2 million is recognized as an expense in the SOPL. After you have done that was in the SOPL, you also need to mention what is the carrying amount to be restated in the statement of profit or loss, a statement of financial position. So the carrying amount will be restated at its recoverable amount of 3 million. So that was the explanation for this part. Okay, class? So you must explain regarding the impairment. Do you notice or not it is similar to MFRS 116? Exactly the same, right? Exactly the same like MFRS 116. Only that
Yes.
the
Yes.
term that you have here is about the amortization. And take note that under impairment loss, you do not go and eliminate accumulated amortization. So if you can see back here, this amortization here, you do not eliminate because this is not revaluation. So no elimination of amortization since this is not revaluation. This is just impairment test. Do not confuse that. Right. Now you have another one here. This is on research and development. So I'm going to do this with you. But let me just close off this for a while because I do not want to erase. Are you done with that?
Yes.
Okay, we're going to do part C. So these are the answer that I have already shared with you. So now let us do part C. I'm going to reopen the same item. So I will open up again the question here. And this is going to deal with a question on R&D, research and development. This is there is a story behind this question. Let's look at this, and I'm going to put this into some timeline as well. So I'm going to explain this using timeline. Okay. Sermaling manufactures and sell consumer product beginning 2018. Sermaling is committed in research and development project. So they involved into the research and development project. The project was to come out with a new product, and they do not tell you what was the new product. Maybe we're not sure what is the product. And they have allocated an expenditure of 300,000 per month. So each month, 300,000 was being allocated. A budget is being allocated for this R&D project. So for the project, this project means for the R&D. I call R&D, research and development. Research phase begins on 1st of March 2019. So this is where the research phase started. Research phase began 1st of March 2019 and the period is 7 months. So you need to draw this later. And development phase, development of the new product began immediately after the research phase was considered a success, and that continued until 31st December. So meaning that it start on 1st of after 7 months, this is completed. The following month, the development phase continues. So I'm going to draw this. And let me just draw that so that you see better. And look at your question as I draw. You can look at your question. Okay, I put here 2019. This is the period 2019. You start when? 1st of March. So 1st of March 2019, and it has to last for how long? 7 months. So 1st of March, for 7 months, it will be until 30th of September 19. So that period is what you call research phase. And research phase for each of the month, you have 7 months, right? Each month they allocated you 300,000. So therefore, under research phase, you will incur some research costs, which is 300,000 times 7, and that would be 2.1 million. And this is the research cost because this is in RM. So this is the amount that is the research phase. So this under MFRS 138, research cost must be written off. So meaning that it must be expense off in year 2019. The standard does not allow research costs to be capitalized. Okay, take note on that. Why? Because the future economic benefit is not probable. Right? The future economic benefit is not probable. Now, after the date, 30th of after 7 months, you will have October 2019. So October 2019 is where the product development phase started. So meaning that it began immediately means 1st of October 19. So 1st of October 19, I will put here still in 2019, 1st of October 19 until 31st of December 19. For the 3 months in the 2019 period, you have come to another phase, which is development phase. For that 3 months, it will be 300,000 times 3. Are you with me? Hello, class.
Yes,
Yes,
yes, madam.
Okay, 900,000. So at this stage, you need to think of whether this can be written off or should this be capitalized. You are informed in this particular sentence, this is important, that the product after the research was a success, so it continues throughout the year ended 31st December 2020. And then you have to read further. The directors of Sermelink were confident on the success and potential profits of the product beginning April 2020. Meaning that somewhere in April 2020, only that the company is confident that the development of the product will be a success, which means that the capitalization criteria under MFRS 116, there are a few capitalization criteria. There are 6, so let me just go to that part. Yeah, this one. This one. So here you have to make sure that the capitalization criteria is being met. That was under paragraph 57. However, in your case, you don't have all 6. So how do you know it is going to be the case? So you can see here, I've highlighted here, normally when the question in the exam, for example, mention that the project is a success, the project become economically viable, or maybe becomes feasible. So with that, you can conclude for exam purpose only that that development cost is a success. So if it's a success, what do we do? Just to share with you. So for the development costs, I'm going to write at the bottom here. Some ruling here. For research costs, everything is expense off. Expense off where? In SOPL. The reason is because future economic benefit is not probable. That was for research costs. For development costs, if if it does not meet the criteria, I will just erase this for this one to highlight. If it does not meet the capitalization criteria, you are going to expense off, because the future economic benefit is not probable, right? The reason is still the same. However, if it meet the capitalization criteria, it is a success. The directors is confident with the capitalization criteria, with the success of the product. So if it met, you are going to capitalize. So when you capitalize, this will be shown as intangible asset, where in your SOFP. When you expense off, it means that you do not recognize as intangible asset. Same goes here. You do not recognize as IA. So we are going to use this here. So for our case, development cost, you need to see whether is it the first case or is it the second case. So this is regarding R and D. R and D. Okay, that was just a little diagram that I drew for you. So for research cost, no doubt it will be expense off. You can check the lecture. For development cost, if does not meet the criteria, any 6 of it, therefore it will be expense off. You do not recognize as intangible asset. If it met, you will recognize. So in our case, the directors are only confident on April 2020. So meaning that in 2019, for that 3 months period, you have to go and expense off, because directors are not yet confident with the success and potential profits of the product. So here you will write off. The reason is the same, because future economic benefits is not yet probable. Write off means it goes to the SOPL. Now I am putting it into period, because I want you to really see what happened, right? Okay, 1st of January 2020 until when was the period that directors become success? Okay, until 31st of March 2020. So here is still the period where you are still under development phase. And this is another 3 months. But remember, this is in 2019. The previous one is in 2019. So it is still the same expenditure that you incur for 3 months. But remember, the first one is 2019. The second one is 2020 for the first 3 months. Why do I split? The reason is because the first 3 months, it was not yet a success. So therefore, you have to go and write off in your SOPL, to the SOPL. So now comes to the period that you think it is a success, starting from 1st April 2020. 1st April 2020 until 31st of December 2020. How long is that? 9 months. So for that period, you are still developing it, but now you become confident phase. And that would be 300,000 times 9, because 9 months is the period, and you have here 2.7 million. And this one will be capitalized. You will capitalize because now you say that the future economic benefit is probable, is being met. Or you can say that the capitalization criteria is also being met. So we have to see that. Okay, that was in 2020. So you are asked to explain accounting treatment. Look at the requirement. Look at the requirement now. So that is the reason why I'm doing all this. You are asked to explain the accounting treatment on the expenditure incurred, which is research and development expenditure incurred in 2 years, 2019 and 2020. You need to explain first round is 2019. This one. Second round is 2020. So you need to explain what you have calculated into sentence. Okay. So there are a lot of sample that I've provided. For example, you can make use of what I have shown here. Basically, you can have a guideline where I have provided example on R&D here. So this is a simple example of how to explain, where this was for 3 years, how to explain accounting treatment for 3 years. But in our case, I'm going to explain for 2 years. But in the self-study example, it was for 3 years, right? So go and check that out. But I'm going to do for this particular one. After you have done that, discuss accounting treatment, you are, where is it? You are also asked to do the journal entry for 2021. So why not we continue with 2021 before we do the rest? So 2021, I just continue the 2021 journey here. So I use blue, I use green, so 2021. So 2021, you can see that this is what happened. Commercialization begins in January 2021. So when commercialization starts, yeah, you will also notice that amortization will start. Why? Because when this began, you are going to provide amortization of development costs. Not research costs, but development costs. Which development cost? Development cost that was being capitalized. Development cost that was being capitalized is this 2.7 million, correct? Because development cost 1.8 million, which is the one 900,000 plus 900,000 here, this is not the one that you capitalize. So development cost that was being capitalized will later be amortized for the next 8 years. So you are going to calculate that, and you are going to look at what is the amortization for January 2021 up until 1st of August 2021. Because 1st of August 2021, you have another information that development expenditure was being revalued. Fair value of development expenditure, which refers to which one? This refers to this 2.7 million. That 2.7 million, you have to go and find out what is the carrying amount. That was the cost. We have to find the carrying amount. And you need to go and compare that carrying amount with 2.73 million because the company adopt revaluation model, and you need to find out what are the surplus or deficit, and take note the amortization are using monthly basis. So that's why I apportion them later. So let's just do this here. 2021, 1st of January 2021 until the date 31st of July 2021. Why do I split? Because August is the date of revaluation. So you will calculate the amortization here. Amortization will be based on development cost capitalized. So it would be 2.7 million divided by 8 years. 8 years is the number of years, and this period, how long is this? 7 months. So times 7 over 12. You will get how much? I'm not sure. You need to go and calculate that for me.
196,875.
Good. 196,875. Okay, take this out from the cost. 2.7 minus 196,875. 196,875 is amortization. We will have to record. But the carrying amount is how much? carrying amount. On 1st of April, 1st of August 2021, you will have the carrying amount. Carrying amount is how much? Take this, 2.7 minus 196.
227.
227, is it? 2.7 minus 196,875. 2.7 minus 196,875. I'm asking what the carrying amount. 2503
125.
125. You will compare this with the fair value 1st of August 21. The fair value is 2.5 million, right? Oopsie daisy. Where is the fair value? This one, 2730 500. 2730 500. Okay, write down that. 2730 500. So if you compare, you will get a surplus, and that surplus is initial revaluation. How much will that be? Just now I heard someone mention 227. What is that?
227,375.
Okay, that was the initial revaluation surplus. You will treat it similar to MFRS 116. So let's just do this. Explain the number 1 and number 2. Number 1 is explain. Number 2 is prepare journal. Okay. So that is the first one, explanation of the research cost. So you draw the timeline. So I will put that side by side again so that you can see better. And you can compare with what you have done earlier. Okay. All right. So you can see that the first one is the year ended 31st of December 2019. So you will be explaining on this research cost and also development cost. I take red. Red is better from the far. Okay, this and this. So 2019. So you have to mention about the research cost, mention how much, 2.1 million incurred from 1st March. Mention the period until 30th of September 2019 should be recognized as an expense to the SOPL. Give the reason, since there is the future economic benefits of the product is not yet probable, or you can also use this, no probability that the future economic benefit of the product will flow to the entity. Or in simple words, since the future economic benefits is not probable. Then explain on what happened in the second part, which is for the development cost that was 900,000 in 2019. So that development cost incurred from 1st October 2019 until 31st December 2019 should be recognized as an expense. The reason is because it does not provide evidence of the future economic benefit is probable. So the keyword is future economic benefits is not probable in our case here. Future economic benefit is not probable. Not probable. Okay. And it does not meet, or you can also write there, it does not meet the capitalization criteria. So that was the first year. You can screenshot that if you want to save your time. Year ended 31st December 2020. So this is the second year. So in the second year, the first 3 months you expense off, the remaining 9 months you capitalize. So you have to explain that in a different sentence. Development cost of 900,000, mention the date from 1st January 2020 until 1st of April. So if you do the workings like this, you can have a good foundation of how to write. If you want to start writing without drawing the timeline or showing whatever the breakdown of the research and development phase, you may have problem to write this, right? So workings can help you. Proper workings will guide proper answer, right? So development cost of 900,000 incurred So that one should be recognized as an expense because it does not meet the capitalization criteria. Or you can also mention since the future economic benefits are not yet probable and it does not meet the capitalization criteria. So the one that I highlight there is the keyword that we will normally be looking for. And 1st January 2020 until 1st of April 2020, you need to mention that date as well. However, development expenditure of 2.7 million, meaning that for the second part of it, which is 9-month period, incurred on 1st of April until 31st of December, can be recognized or can be capitalized as intangible asset if the reason that there was an indicator for future economic benefits will be probable based on the sentence in red here. The since directors are confident with the success and potential profits. So you can mention that. So that gives you 8 marks for that explanation. The next part is the journal entry for the uh, revaluation and also the journal entry for amortization and accumulated amortization. So for revaluation, it took place on 1st of April here. So you will compare fair value, you get the figure 227375. So you will debit development cost, credit ARR, development cost. On the date of revaluation, before the revaluation, you do provide some accumulated, you do provide some amortization before that, right? So that amortization here is between first of this one, yeah, between 1st of January 2021 until 31st of December 2021. So 2.7 divided by 8 times 7 over 12. So you get 196,875, the one that you calculated here. However, on the date of revaluation, you eliminate what you have here. The green one, first you record, and then you go and eliminate. Starting from 1st of August 21 until 31st of December 2021, your amortization will now be revised, where that shouldn't be no longer be on the uh, the same amount here, one which is 196,875, but it should be revised because the remaining useful life of the asset and everything has changed. For that, the remaining useful life is still 8 years, but the number of months that you will provide amortization is for the next 5 months. 5 months means since 1st of August until 31st of December. The one here, let me just put here, is 1st of January 21 until 31st of July. So you split between the monthly basis there. 7 months before revaluation. This one is 7 months after revaluation, where you take the revalued amount, fair value, 2,730,500, divided by 8 and times 5 over 12. So 142,214. So even after the revaluation date, you provide amortization since this is monthly basis. And you are asked to do the journal entry for the year ended 31st of December. Do not forget to do this amortization after the revaluation period. So make sure you do the correct calculation. That's it for this. Okay, I have finished with one question that show everything, mostly everything about R&D. The reason that I choose this question is because it will cover mostly what you need to know. Okay, this is the reason. All right. So look at how to explain, what to record. But only maybe some question can ask you how to disclose this or present this in the extracts of Pearl, extracts of P. So all these are provided in this handouts as well. Where to present. Here, you can see here. Yeah, you can do the same for our question, where you can go and show research cost in our question, development cost, amortization in the correct years where that was incurred. And on the non-current asset, development cost will be part of the intangible asset, but the one that was being capitalized. You can do that as well. So make use of these handouts that I have provided. Okay, we'll just stop here for this particular part. We will continue later. Thank you.